Welcome, guys. Okay, the views discussed in this webinar are those of TraderBot Marketplace and do not reflect the views of Cantor Exchange. Cantor Exchange is not affiliated with TraderBot Marketplace. We just work with them on some ideas. Here's a CFTC required trading disclaimer. The risk of loss trading any financial instrument, such as Forex or binary options, can be substantial. You must be aware and willing to accept those risks in order to invest. Don't trade with money you can't afford to lose. This is neither a solicitation nor an offer to buy or sell any financial interest. No representation is being made that any account is likely to achieve profits or losses similar to those discussed here. Past performance is not indicative of future results. Any strategies discussed are for educational purposes only and are not to be construed as specific trading advice. This material is for educational purposes only. Okay, we're going to cover 5 topics today, guys. 5 topics. Using multiple strike levels offered at Cantor Exchange, basic in-the-money strategies, basic out-of-the-money strategies, a risk and reward discussion, application in trading markets at low and high volatility. If you have any questions, please post them in the chat box, and let's get started here. I'm going to go ahead and discuss the last one first, but I'm going to start with a couple of questions. First of all, do you know what volatility is? Don't worry about what anybody else thinks. Everybody's in here to learn. I learn things from you. You learn things from me. So if you don't know what volatility is, let me know. Thank you. All right. If you don't know what volatility is, let me know. And also, if you don't know what ITM and OTM is, let me know. Okay, that's good. Thank you. We're going to go ahead and discuss that. I'm going to pull up my my notepad here. There are 5 basic terms in binary options. There's ITM, ATM, OTM, strike, and expiry. We're going to go over these really quickly. ITM, this means in the money. This means that you're trading where price already is, at the money. You know what, let's do it like this. Let's look at a chart right here. We are looking at the Euro USD. We're looking at a 1-hour chart. And you can either buy it or you can sell it. It doesn't matter. There's different strike levels. Now, within these strike levels, do you see this blue line up here? You see that blue line? Those are different strike levels where you can buy and sell at. Anywhere on the spectrum, you can buy and sell at any of these. Now, if I'm buying or if I want to go long, it means I want the market to go up. Now, if I'm buying, and if you look at this strike level, let me open this up a little bit. There we go. If I'm buying right here, and I want to buy at this strike level of 119.35 right here. I want to buy right there. Is this an OTM, ATM, or an ITM trade? Well, it's going to be an OTM trade. The reason is it's called out of the money. Price is not up here to this level yet. Actually, I want to take a little screenshot here so I can draw for you guys. And we're going to be talking about buying only. Now, if I want to buy at this strike level, I'm not going to have to pay a whole lot for it. Definitely not 50, or hopefully not. Now, the farther up the strikes get, the cheaper the contract is going to be. And the reason why is because the probabilities of price going all the way up and expiring above this line gets farther and farther away, or gets lower and lower as this strike level moves up. So you're not going to have to pay as much. Now, on the other hand, if we're selling and we're selling this strike right here, we are going to have to pay a little bit more. But this is called an in-the-money trade. The reason it's called an in-the-money trade is because if the price expired right now, the price is lower than the strike. If the price doesn't move anywhere at all, it just sits there, and you take this trade, you sell this strike right here. If price sits there and expires there, you're going to win your trade. So you have to pay more for that contract versus an OTM or out of the money contract. You always pay more for an in-the-money contract because price is already there. It doesn't have to move. Nothing has to happen for you to win your trade. Now, the other one is called an ATM. These don't come up all the time. An ATM would be taking a strike right where price is right now. However, you can see right here, let me pull this down. There are two strikes here, and price is in between both strikes. They're in between both strikes. If I wanted to buy this strike right now, I would have to pay 87 for it. If I wanted to sell it, I could sell it at 71. Likewise, if I wanted to, where are we at here? If I wanted to buy this strike, it's getting really close to at the money because price is up near the blue line or the strike. So when it gets up there, this is probably going to be right around 50, whether it be 45 or 55. It's going to be right around 50. So that is OTM, ITM, and ATM. Does everybody understand these concepts? If you don't, well, let me know, please. Now, expiry is a biggie. In every, okay, we'll get into that now. In every binary options contract, you're going to have an expiry. Now, let's draw a vertical line here. Let's pretend that this is the expiry. You know what? This is not a good picture. Let me choose another one here. Okay. Let's pretend we're selling this. Let's pretend we're selling this, and here's the strike we want to sell. Let me put another strike down here, and let me put a vertical line for an expiry. Now, if we're going to sell this, we want price to go down here and expire below this line by the time expiry occurs, which is this period here. Now, if price gets down to this line and just expires one tick above it, you're going to lose your trade. If price gets down here and expires at least one tick or more below it, you're going to win your trade. It's pretty much all or nothing. And it's going to cost you, let's just throw out a simple arbitrary price. Let's say you're going to pay $20, or you're going to sell this at 80. Okay, you're going to risk 20 for it. It may cost you 20 to do it here. However, if you choose another expiry, say farther out, it may cost you 30. The expiry will help in determining the price of your trade. Let's go look at it in real time. Let's look at a strike here of 119.35. Now, if I want to buy this right now, it's going to cost me 60. However, where are we at here? What strike did we choose? I totally forgot. 119.35. Okay, it's going to cost me 57 here. However, if I wanted to choose a different expiry right here, okay, it's going to cost 56 right now because it's at the money. At the money is 50-50 always. However, if I want to buy an in the money, I can't. Price has already moved up too far. There's only 10 minutes left in the contract. I can't even get into that trade. However, that's at 119.30. However, if I wanted to go a little bit farther out, 119.30, I can get into the trade. The price is very expensive. It costs 96 to get in. Now that's out of 100. So you're risking 96 or 97. You're risking 97 to try to make 3. I'm not really going to do that. Risking 97 to make 3, yeah, it's probably going to win. However, that one time that you lose, you're going to lose 96 or 97, which means you're going to have to trade, I don't know, 10 or 15 times to try to make up for that loss or even more. So whenever you're getting into a trade, you always want to look, okay, how likely is price to close right there, or at least, you know, above that strike by expiry. And also, you need to look at risk. How much am I risking on that trade? Well, if I take a at the money trade here, I'm risking 53. That's all that I'm going to risk on that trade. Now, I'm going to place a trade here. I'm just going to place a little one contract trade. I'm going to go down for a smaller expiry or a shorter expiry. We've got about 9 minutes left in this contract. Now, I'm not placing any technical analysis to this. I'm just going to place an arbitrary trade. Let me see here. I'm just going to buy this at right here at 40.49. Now, when that trade goes through, it might take a few seconds. When that trade goes through, it's right here in my trades area down here. If it doesn't go through, it's going to go into my orders. But it did hit, and right now, here is where the trade shows. I'm showing I bought it at 41 right here. The current market price right now is 30, which means it's not up to the strike yet. And here's my unrealized profit and loss. Now, if this trade does nothing right now, it's got to expire above 119.35, and right now it is at 119.351. Now, even if this is showing a loss right now, if it were to expire at 119.351, I'm still going to win my trade. It's got to expire just one tick above it. I don't care whether I win or lose this trade. It doesn't make a bit of difference to me. But as I'm explaining this to you, but in when you're trading real money, you want to make darn sure you've got the proper strike. Hang on just a second. There we go. We want this to expire above this line in about 8 minutes or so. Give me a second here. Now, using multiple strike levels offered at Cantor Exchange, in every single contract that's offered, there's multiple strike levels offered. You don't have to choose just one. You can choose any of these. It's not like the way some people think about binary options. It's not you pick the price and then you just let it expire or whatever. You can choose multiple strike levels, and you can choose multiple expiries. Now, the liquidity at Cantor Exchange has went way up here recently. Here we got over 6,000 contracts. Here we got 1,000 contracts. And actually last week I placed a rather large trade and got in rather easily. Every contract was billed. So you can trade larger through Cantor Exchange now. And whenever you're going in here and you're looking at the markets, the first thing you want to look at is, where is the trend? Which way is the trend going? You can press this little out button to try to see that. Now the trend is going down right now. It's not going down perfectly, but it is going down. Is it going to fall further? Probably. Over the long term, is it going to fall further within this one bar? Who knows? Right now, the current small trend is up. So I know that. I know that the current small trend is up. I know that the long-term trend is down. So if I'm taking a trade within the hour, it's okay for me to go long. The current trend is up. If I'm taking a trade that may expire end of day tomorrow, like later, I may want to go short. This is what you need to do whenever you're analyzing your chart. You need to find out where price is, where the current trend is, and we're just going to watch this trade right now. Right now, if it was to expire right here, it would be profitable because it's at 119.352, which is 2 ticks above the strike right here. 2 ticks above the strike. So whether you go long or short, it depends on which way the market has been trending, number one. Now there are different strategies for things like strangles and butterflies and all that. That's a topic for another day. So let's talk about risk and reward. I want somebody to answer me. If I am buying at 80, how much am I risking? How much am I risking? Okay, if I am, look at it like this. If I go to a car lot and I'm talking to a car salesman, I say I want to buy this car for $80, $80, 80,000, whatever. I want to buy it at 80. I'm risking 80. How much can I make? Well, I can make 20. If I'm selling, however, here's where some people don't. If I'm selling at 80 and I go to the car lot and I say, hey, I want to sell you my car for 80. out of 100, what is my risk? What is my risk? If on a scale from 0 to 100, if I'm going to sell my car at 80, what is my risk? So if I'm buying, I'm risking 80. And if I'm selling, I'm risking 20. And that's the way it works. It's just think about it whenever you're trying to buy or sell anything. If I'm going to buy something for 80, well, I'm risking 80. If I'm going to buy something for 50, I'm risking 50. If I'm going to sell something at 80, I'm risking 20. Or if I'm going to sell something at 20, I'm risking 80, because the standard goes from 0 to 100. If I sell at 20, the most I can make is 20, and the most I can lose is 80. A lot of people say, well, I'm not buying at 80. That's just too much risk. Hang on just a second. Give me a second here. I'm going to keep an eye on this trade. I want to find out if it wins or loses. Okay. Where's my... If I'm... a lot of people say, I'm not buying at 80. That's just too much risk. Well, technically it's not. And here's why. What if something happens over and over and over, and you can spot that in the market, and it happens like 93% of the time? Are you going to buy at 80? Most likely, because the probabilities of that trade expiring profitable are high. Now, if something won, 50% of the time, just an average everyday trade, am I going to risk 80? No, I'm not going to risk 80 at all. I'm going to go for what's called an OTM trade, because my risk is smaller. Now, if I'm risking 20 over and over and over, I can lose 5 trades. I can lose 5 trades and still be just fine. If I'm trading, buying something at 80 or 84 or whatever, and I lose 5 trades, well, I've lost a lot of money. So you have to be careful there. You have to gauge your risk versus your reward on any given trade. Let's look at a couple of examples. We're going to go with something that I like to use. I call it the bar run. All it is count how many bars are going in the same direction. Now, there's analytical tools out there that you can use. Personally, at TraderBot Marketplace, we have something called the tool suite. That's what we use to gauge risk. And you can use any tool that you want. But I know that if something goes in the same direction, about 4 to 5 bars, that's when I want to start looking to take the opposite direction of that trade. That doesn't mean that I'm going to get in. So one thing that I'm going to do is go back here and look. Okay, I want to find 5 bars in the same direction. Then I want to see what happens. Well, there's 4. Well, here's 5. Let's go look. We got 1, 2, 3, 4, 5. Now, when these 5 bars happened, the next bar went up. Me personally, I like to look for a counter trade trend right there. Would I have taken this trade? Who knows? However, how far did it go up? Well, it went up a little bit, but it didn't go up a whole lot. And that's what I see a lot of times on this setup between certain time frames. Hang on just 1 second. We got 1 minute and 12 seconds left in this trade. Here is the buy price. Here's where it's at now. Now, if I want to close this trade early, I can. If I close the trade early and I get filled where price is right now, I'm going to make 37 cents on this contract. Let me go to the end here. I'm going to let it expire, and it's going to expire in about 47 seconds. However, going back to what we were talking about here, let's say this trade loses, and the probabilities for 6 bars in a row go way down. Well, I'm not going to take that next trade for the simple fact that I know that my risk is higher now. I'm just going to take that loss and move on. I want you to keep this one. If you learn nothing else from this webinar, I want you to remember this one thing for the rest of your trading career. Whenever the risk goes up, traders have a tendency to not want to give up on their trade. If they lose that trade, a lot of times their mind is going to tell them, no, if you get in on the next one, you're definitely going to win, and then they'll lose that one. And then they get in on the next one and the next one, and before long, they lose a lot of money. Don't do that. Yeah, Dan, I've been there too, many, many times. It's revenge trading. Don't do it. If you lose a trade, the best thing you can do is to get up, walk out of wherever you're trading, go take a walk. You know, get irritated, whatever you want to do, leave your computer. What this does, it helps reset you into a okay, that's fine attitude, instead of being irritated and revenge trading. Revenge trading will help you lose an account rather quickly. Okay, let's talk about volatility. In the beginning, I asked if everybody knew what volatility was, and I didn't see if I won that trade or not. Where are we going here? I don't know, I'll check it later. Anyhow, what volatility is how far the market moves up and down in a specific time. For instance, I see one period of high volatility here. See this big red bar? Well, don't know, maybe it's news, whatever. I really don't care. But this period here, it was, number one, it was trending during this hour. And number two, it was high volatility. Volatility measures how far the market moves up or down. Usually it moves in a normal range, about 80% of the time. But about 20% of the time, it does something unexpected, such as this bar. Now, looking at this chart right here, the way we see it right now, this chart right here, I would say a lot of traders went long because the market is trending up. However, it took a dump and started falling from there. This created a high volatility area. Now, during high volatility, your prices are going to change, because if price has already fallen, you know, I don't know, 100 pips or whatever, these the premium on ITMs or OTMs or whatever are going to change because they have to compensate for the market. Well, earlier today, we could get in for a lower price, but now since volatility is huge, the prices are going to be more expensive, let's say for an ITM or something like that. Whereas earlier today, maybe on this bar right here, I could buy this strike right here for a rather reasonable price. However, if I want to buy this strike right here after this bar, it's going to, if I want to buy this price after this bar, I'm going to pay a lot more for it, for like in the money trade, or I'm going to pay more for an out of the money trade as well. But volatility will affect your pricing. Hang on, I think there was a question. I will get to it in just a minute. So volatility does affect your pricing. The pricing that volatility will not affect is ATM pricing. If price is right here, it's always going to be right around 50, 45, 55, whatever. But if price is right here, it's always going to be there. The ITM or in the money, and the OTM or out of the money pricing is going to change with the market. So you have to be careful with your volatility. What causes volatility? News, maybe a politician opens his mouth, maybe somebody sets some type of monetary policy wherever in the world, maybe they change an interest rate. Interest rates are big ones, but the big ones that you have to watch out for, the big news announcements are NFP or non-farm payroll, interest rate decisions, or when somebody at the FOMC speaks. Those are the three big ones for me. There are other news releases that can move the markets all the time, especially in stocks. But for the Forex market, which we're trading a derivative of the Forex market here, for the Forex market, usually a major news release happens, and you can go on the news wires and find out when those news releases happen. So all in all, you need to be aware of volatility in the markets. You need to be aware of how much you're paying, your risk and your reward. And whenever you're looking at strikes, you need to know, okay, how often or what is my probability that this strike is going to win or lose? Okay. Whenever you've got those three down, then you can start focusing a little bit more. Do we have any questions so far? We're about 24 minutes into this. Hang on. Yes, okay. The question was, when you say long, are you talking about a trade to end at the end of day? No, long. There are a few different terms here. Okay, we all know what buy and sell means. We all know that buy means go up, sell means go down. Then we've got long and short. I couldn't tell you where these came from. I don't know. Go research it on Google. But long means buying and short means selling. I don't know why, but that's what it is. So whenever you're talking about going long, you're talking about you're wanting the market to move up. It doesn't have anything to do with expiry. It's just if I say I'm going long, well, I'm buying, or I want the market to move up. Or if I say I'm going short, I want the market to go down, or I'm selling. Some people also refer to it as short selling. It's the same thing. Going long, going short or short selling it's practically the same. If you want to get real nitpicky, you can't really short sell in Forex or binaries. You can't do that. In stocks you can, but it's the same thing. It's the same thing. You're going short, you're selling the market. Do you understand? Oh, let me talk about that too. Puts and calls. There's so many terms. Okay, a put equals short equals sell. A put equals short, and it also equals a sell. A call equals long, and also equals buying. It's different terms for the same thing. Different terms for the same thing. So put, short, sell means the same thing. Call, long, buy means the same thing. Does that answer your question? Okay. Bid and ask. We got another question. Now, if you will look over on the left-hand side of your screen here, you're going to see an ask right here, and you're going to see a bid right here. Let me pull up my picture again. I'm glad to see there's quite a bit more participation this week than there was last week. You guys wait till next week's webinar. I'm going to knock you on your rear. Okay, bid right here. Bid means you're looking at a price to sell. Let me get on something that's got some liquidity here. All right. Bid means you're looking to sell. Now, if I wanted to go over here and I wanted to try this 82 bid right here, I want to sell that. If I'm looking, I want to sell that at 82 or risking 18. Well, I'm not going to do that. Actually, that might not be a bad trade, but that's okay. Hang on just a second, guys. I got you, AJ. Hang on. If I want to sell this bid here at 28, I can do that. If I want to buy this ask at 42, I can do that. If I want to buy this ask at 96 or buy it at 17, I can do that. All this pricing here, ask is you're looking to buy. The bid means you're looking to sell. Now it's kind of I'm not getting into Forex. I'll do that on another webinar. But that's what that is. The quantity means how many contracts are available at any given time. You see right now, this price right here has 909 contracts available. What happens if a trader comes in here and they purchase 909 contracts? Well, that's going to go to zero. Somebody just purchased some because this fell to 833. Either they purchased some or the market makers decided, oh, my risk is too high, I'm going to lower that risk, and they took some of the contracts away. So if you're looking to buy, look at how many contracts are available. If it's got 2 contracts available and you want to buy 50, well, you can put it in there. Your 2 contracts are going to get filled, and then your other 48 contracts are going to go over here in the market, hoping somebody else wants to trade with you. Okay, that's pretty much the webinar for today. I just wanted to cover a few little topics. We covered volatility, the different bid, ask, buy, sell, short, long, all of that. We talked about in the money, out of the money, and all of that. So let me ask you a couple of questions. Does everybody know what in the money is, what it means? If you don't, let me know. Again, same thing with out of the money, at the money, strike, and expiry. Does everybody know what all of those terms mean? I'm going to take a sip of my coffee while I wait and see if you Sorry about that. Okay, good deal. Hey guys, if you have any questions, hang on me. If you have any questions after the webinar and you need somebody to talk to AJ Grossbart over at Cantor Exchange. He's a great guy. He will help you in any way that he can. I talk to him about every other day. Just send him an email and he will respond to you. So if you have any questions, contact AJ over at the Cantor Exchange. Okay, well, that's about it. Oh, hang on, I got a question. Yes, but is there a range for ATM? Dan, can you explain what you mean? Is there a range for the ATM? While you're typing, I will try to decipher. Okay, ATM means right where the price is right now. You see that blue line? Look right here. You see that blue line? This is right at an ATM price of 50. Now, if you're going to sell it, you're paying 36. If you're going to buy it, you're paying 50 right here. Hang on, let me read your question. Yes, but is there a range for ATM? Does it mean exact price at the money or down a pip or two is acceptable? Okay, the ATM strike means if price, right now price is at 119.346. If it gets up to 119.35, that's an ATM price, or that's an ATM strike. Now the price may be a little different. The price may be 55, it may be 60, it may be 45 if it's a tick or two below it. But right when price is at the strike only, it should be, if the strike lines up to a 5 pip increment such as 119.35, 119.40, 45.50, 55.60, if the price is at 119.35 and the strike is at 119.35, it's going to be right around 50. I can't tell you what exact price that would be. It fluctuates by the millisecond. It might be 50, it might be 60, it might be 55. Right now, it's just a hair below and it's at 54. So, but the prices always change due to people trading. Okay. Yeah. Okay. All right. Got you. Okay. I'm going to go ahead and end this webinar.